I'd like to talk about a slightly different aspect of systemic risk, which is illustrated in this picture. That is, the financial system continues, somewhat like a volcano, to be inactive, but possibly not. In other words, if you look closely at this picture, you might see that there's, well, on the monitor I can't see it, but there's a little wisp of smoke coming out the top. And the question is the financial system going to erupt again or not? And can we build monitoring tools that give us an idea where the risks are and how close we are to them? I mean, this is exactly a response to Arvind's, I think, question. So I'm going to show you stuff that we have on VLab, which is the website, which you could see on your phone if you choose to do so, which is updated for many things every day and for systemic risk once a week. If you Google it, you'll find out where it is. But if you open it up, you'll see immediately a map of the world. And the map of the world is a volatility map, which tells you that where it's red, the equity markets are highly volatile, and where it's green, they're low. And this is a day or two ago. You see we are in a high volatility period, but it was only a couple of weeks ago it was low volatility. So volatility is changing very rapidly on a day-by-day basis. Further measures of risk are in the website, and we have sections on, as I say, volatility, correlation, systemic risk, which is what I'm going to talk about today, long-run value at risk, liquidity, fixed income, and climate risk. So let's see what kind of monitor we can put together on systemic risk. There's a lot of view, maybe which comes initially out of Basel, but I think we might even have a consensus here that financial crises are really caused by excessive credit growth. I mean, the phrase is sufficiently vague that we almost all could agree with it. And the real issue is how on earth do you measure when credit growth is excessive? And I'm going to propose a measure which, again, would probably be different from what everybody else does, but it's designed to measure when credit growth is excessive. And let me motivate it by an example, which is from the mortgage market. In the end of a credit cycle, what you would imagine to see is that you would see banks and other financial institutions lending money to underqualified borrowers and using overvalued collateral. What that means is that the market value of these mortgages will be less than the accounting value. So the difference between market and accounting values immediately is important. This difference is accentuated if there's a downturn in the economy, because then the borrowers become even weaker, the collateral becomes weaker, and the market value of the mortgage will go down. At this new level of market value, a lot of the corporate, the bank's capital reserves will be allocated to covering these losses in the market value. And if there is not a sufficient capital cushion, the bank will either face bankruptcy or look for a buyout or a bailout. And so with this kind of motivation, what we have in mind is that excessive credit growth is what we call excessive credit growth is when the financial institutions do not have adequate capital to cover losses in a downturn. So this is actually very close in spirit to stress tests, but we're going to do it with market values, and we're going to do it without seeing the balance sheet, without seeing the supervisory data. So this motivates the definition of SRISK, which stands for systemic risk, which many of you have seen many times over the years. how much capital would a financial institution need to raise in order to continue to function normally if we have another financial crisis? It's kind of a bailout estimate. And many of my colleagues have contributed to this, and Matt and Thomas and Viral and Christian Brownlees, and there's a lot of references on this slide. So what is capital shortfall? We think that there ought to be some relationship between the amount of equity that a firm holds and its assets. Let's call that capital ratio little k. And if the desired capital is greater than the amount of equity that they do hold, we say there's a capital shortfall. We're going to use a measure of assets, which is the accounting value of debt plus the market value of equity. So it's a little bit of a mixture there. And so what we want to know is, what is the expected value or the median value of the capital shortfall if we have a crisis? So this is a counterfactual. We need a model to estimate this. The model we're going to use is totally familiar. We're going to recognize that the equity change for a particular firm is its beta times the growth of some aggregate equity market measure. We use a world equity index, an all-world ETF, AWCI, and we're going to ask, if the global capital market falls a certain amount, what do we expect is going to happen to this firm? Okay, we calculate that. The key issue there is, what is the beta? And so we need to talk a little bit about the beta, because this is not an ordinary beta. This is a time-varying beta, and the beta changes actually every day. In fact, we know simply that the beta is going to be the correlation times the ratio of two volatilities. And I just showed you that volatilities are changing all the time, so it makes sense to think that the beta is actually changing over time. In fact, it also changes because correlations change. So we estimate this with something called dynamic conditional beta, which essentially takes volatility estimates, puts them in the beta formula, dynamically estimated correlations. We use the dynamic conditional correlation model to put in there. And we have then a beta, which is an optimal forecast of the beta using information that was in the past. As a sort of a check that what we're doing makes sense, we run what is really a non-nested test of whether this beta works. That is, we put this beta times the market return into the original regression to see what kind of a regression coefficient we get, and we put into the same regression a fixed beta. And so if this is really a good estimate of beta, we'll find no fixed beta, and we'll find that the theta in this model is close to 1. It often turns out that it gives a coefficient of theta which is around 1, but it also turns out sometimes it's considerably less than 1, which suggests that we shrink this estimate of time-varying beta toward a constant value. So this is the way we do it. One of the things that I've done in this paper is some analysis of how much risk there actually is in these kind of S-risk measures. And this includes sensitivity analysis to changes in the capital rate and changes in the stress. It includes econometric uncertainty because there's standard errors on these betas. And the standard errors are a little complicated to figure out because it's sort of 3 different models. So I bootstrapped them, and because you've got some thousands of observations, the standard errors actually are pretty small. There's model uncertainty, and we've actually got several different models on the website, and so I compare them in here. And then there is, of course, uncertainty in whether the data is well measured, and that's particularly important for the accounting data. We don't do any specific adjustment for it, but it's certainly worth paying attention to that. So here's what you got. Here's the beta for Citibank over the last, I don't know, 10 years, I guess. That's basically what we're doing here. And what you see is that on average is somewhere around 1, not surprising number, but during the financial crisis it rose to something up to 4, which meant that every time the global market went down by 1%, Citi stock would go down by 4%. Why is that? Well, it's because Citi was very exposed to the same products that were driving the global capital markets, which were basically these mortgage-backed securities. So I think it makes sense, and it shows how vulnerable Citi was at that point. If you look at Goldman, for example, you see it did not go up nearly as much during the financial crisis because, in fact, Goldman was pretty well hedged against these risks, but that Goldman's average beta is a little bigger than 1 because it's riskier than Citi. BNP Paribas, for example, has very little effect during the financial crisis, but it did go up a lot during the European sovereign debt crisis. And if you look to the right, you'll see it actually went up fairly substantially where this sort of narrow peak on the right, which is Brexit. So the beta for BNP went up during Brexit for a while and then came back down again. And Barclays had the misfortune of participating in each of these crises, and its beta went up for the financial crisis, the sovereign debt crisis, and Brexit. So if we put these things together, we get estimates of S-risk for something like 1,200 financial firms around the world, which we update every week. What do we see? So this is actually a picture of risk. And it's a personal picture, actually, because if you can see that pink visor, well, that's my wife. And I'm next to her, and my kids are in front, and the guy with the oar in the back is the risk manager, and he has about a second and a half left before he loses all his credibility. So what do we see when we look at this? So here is kind of a summary picture. This is what it would cost to bail out all the financial institutions in the world if we have another crisis like the last one. And so you see the number for the financial crisis that we have been focusing on is something like $4 trillion. It was a little more than that during the European sovereign debt crisis. And then there's a third peak there, which doesn't have a name, but I think it's due to the slowdown in the Chinese economy that led to resource prices collapsing all over the world and putting pressure on financial institutions in all resource-rich economies. And you can really see it in a lot of these, in a lot of ways. But there's also one more. What's this last little one doing up there? I mean, this is the advantage of high-frequency monitoring. I think this is a second China problem, which is associated with the debt in China, but it's also associated with the trade war that is going on. And by looking at this in a high-frequency basis like this, we can actually see these events as they're happening. So, oops, 5 minutes, okay. China is the biggest contributor to this. If you look at the US, you'll see S-risk has been going down. We've been talking about that today. In a lot of ways, things are a lot more stable in the US. If you look at China, you see a totally different picture. The debt is increasing very rapidly. The undercapitalization of the banking sector is dramatic. And you see this last peak, which I think of as the trade war peak, being very substantial. A moment to look back. On the website, we have details. One of the details is you can look at what this looked like at any moment in time. And this is what it looked like August 29th, 2008. So this is 2 weeks before Lehman's bankruptcy. And if you look at the S-risk numbers, Citi is the highest. It looks like it would have needed $138 billion. then we have JP Morgan, Bank of America, Morgan Stanley, Freddie Mac, Merrill Lynch, Fannie Mae, AIG, Goldman Sachs, Wachovia. We don't get to Lehman until we get to number 11. But if you think about it, the first 10 were all basically rescued. And so essentially, my view is that the decision, assuming it was all just done on economic grounds, was put in a very reasonable order. But there's a question where you draw the line. And there's Washington Mutual down there a couple later. And if you had drawn the line below Lehman, then you'd have had to deal with Washington Mutual. I don't know quite how you decide where the line ought to be, but it seems kind of consistent with these numbers. There was advance notice. This is a year and a half before. This is 3 years before. So the question is, that I wanted to close with is, how much S risk is really too much? And this is a picture that's obviously too much risk. So there is a separate paper which is on how much S risk is too much, which is with Tianyu Ruan. And basically what we try to do in that paper is calculate, given the S risk that you see, what's the probability that this country is in a crisis? And then we also want to know how much S risk can this country really tolerate before the probability of a crisis gets to 50% or more. So how do you do that? Well, we need sort of an economic model, but the economic model is that when firms have high S risk, they're vulnerable. And either the regulators or the risk managers are going to tell them to reduce their risk. The most common way to reduce risk is to sell assets to reduce their liabilities. So the question is, what's the probability you get a fire sale out of this kind of asset sale problem? And that depends on how much assets need to be sold relative to the total assets that are out there. If the fraction of total assets that need to be sold is 80%, you've got no buyers, you're going to have enormous price impact. I think that's what we saw with the mortgage-backed securities. There was no market for those during the financial crisis. So that's the variable we want to include in this model. We want to try to predict Romer and Romer's crisis measure, which is something between 0 and 15. And we're going to predict it with a panel regression model that estimates using a Tobit, because all these zeros mean that we don't want a straight line. We want a hockey stick for our prediction method. And what do we see? Well, here are the regression results. But I'm going to show you some pictures from the green curve, which is the kind of the global model, which says the risk depends on S risk divided by total assets, but it also depends on what's happening in the rest of the world. It depends on whether other countries have high risk, and it depends on whether other countries' risk is growing or declining. So with that much justification for this model, which really deserves a lot more than that, but anyway, what do you see? Well, first of all, I want to say what this does is focuses on two externalities that we all think are important. One is that the riskiness of having a financial crisis depends not only on one firm, it depends on all the firms in the country. And so no firm has sufficient motivation to reduce its risk because there's a common because of the externality. But that's also true across countries, that the risk in one country depends on what's going on in the rest of the world. And this is an argument for why we need to have some kind of regulation or coordination of risk across countries and within countries. So here's the same picture I showed you, but with two new features on it. This is the S risk for the US, but in the background is the capacity. So this is how much S risk the US can tolerate without having the probability of a crisis go to above 1/2. And what you see is mostly the US was below its capacity, but not during the financial crisis. In fact, the capacity number drops behind the S risk, meaning that the capacity that the US would have had to cut its S risk by a whole lot in order to avoid the crisis in 2008, 2009, but that's because the rest of the world was weak too. Okay, so the bottom curve gives the probabilities. And you can see it was about 100% that we were in a financial crisis. We're not too shocked at that. Today, it's very low. Here's Spain, for example. You see that it really was devastated by the European sovereign debt crisis. Here's Greece. It was even worse, but it has a secondary peak as the IMF renegotiated the IMF and the triumvirate renegotiated the loan package. Australia is a much happier story. It never really got close to its capacity and didn't really have a financial crisis. And these things are updated every week. Take a look at them on VLab. And my final slide is two of my grandsons looking out over this lake. What's in their future? Did we have another financial crisis or not? And, you know, I think we've got some things to worry about, but I leave you with that. Thank you.